Can the Federal Reserve pull off a soft landing, or what makes this time different than what happened in the mid-90s? Why would we not have a soft landing like we did in the mid-90s? Just because we cut 50 basis points just like we did in September of 2007 or in 2001, leading into the good old dot-com bubble bursting and the Great Recession. Why is the Federal Reserve convinced that this time we will stick a soft landing? Or are they not convinced, and that's why they cut 50, and maybe things are actually quite the opposite today as they were in the mid-90s? Well, in this video, we're going to analyze some old FOMC transcripts that I went through. That's the Federal Reserve's Open Market Committee, and I spent my weekend reading some of these transcripts just to see what things were like in the mid-90s, so I could tell you what the Federal Reserve was seeing in the mid-90s, and we can compare what was happening then to today so we can see, can we stick this soft landing just like we did in the 90s? And we're also going to go through later in the video what the heck Challenger just said about our labor market today, and it came as a big surprise to me. So stay tuned and buckle up. Let's get right into it. So first things first, I just want to cover some things we already know that are, quite frankly, the opposite of the 90s. This is old news. You should already know about this. This is not new. I just want to catch you up just to address it very quickly, okay? And this is not what this video is about, because this should be basic to you. You should hear this and be like, I already know that, okay? So to catch you up, just in case you didn't, the 10-year and the 2-year yield curve inversion, fancy way of the market trying to predict a recession. It's basically never wrong. And when this inverts, that is, when we go below zero, we tend to have a recession within a couple years thereafter. We briefly inverted right before COVID. We inverted right before the 2007 recession. That's basically the blue line going under the black line. And we inverted before the dot-com bubble. Did we invert in the 90s? Nope. We got close, but we did not invert. Did we invert before the 1990 to 91 recession? Absolutely we did. And we can kind of keep looking at that, but honestly, it gets pretty redundant. So the first thing we know is already the opposite, is that we've been the most inverted here since the 80s. So we have inversion now. We did not in the mid-90s. We did not have a SOM rule trigger. This is growth in the unemployment rate by a certain percentage above. We're not going to get into the details of the 3-month moving average compared to last year. Basically, unemployment rate starting to accelerate going up. And it could be an indicator of recession coming if we go above a level 50. Now, again, this is just catch up. You should already know this. We just hit that level, just like we did before 2007, 2008, before 2001, before the 91. You get it. Like these are known indicators at this point. But what was the Federal Reserve seeing that is similar or different today in their summary? Well, actually, not even their summary. Their straight up transcripts. What were they talking about? Well, I'll give you my sort of summary on it. February of 1994, that's where I started. I started in 94, and I found a Federal Reserve that was concerned with the start of the tightening phase. So to me, that sounds a whole lot like kind of a 2022, where we started seeing rates go up. And that's because the Federal Reserve was concerned about the economy growing too rapidly and us getting wage inflation. Well, that's definitely not what we're seeing right now. The Federal Reserve is concerned that we're going to slow down too much, that they're behind the curve. They don't think they're behind the curve. They say, they tell us that, because if they did tell us we were behind the curve, they'd create panic in markets. It would be very bad. So they kind of have an incentive to lie to us. But anyway, let's take them at face value and assume that we're not yet behind the curve, even though we probably are. Concerns over the economy growing too rapidly are certainly the opposite of what we're facing today. In addition, in the February of 1994 transcript, they were worried about wage inflation and a wage price spiral. And that's because the economy was really starting to ramp up after that 90-91 recession. Things were taking off and looking really good. So the Fed started raising rates to try to put a lid on inflation. They were worried that there was going to be so much economic growth, wages would skyrocket and you get a wage price spiral. They started seeing commodities rise, and when we started going into May of 1994, they were complaining that the prices for things like steel and aluminum were rising in price. Somewhat, again, the opposite of what we're seeing in markets today. We have a Federal Reserve today that's not concerned about a wage price spiral, and if we look at the BCOM index, which is the Bloomberg Commodities Index, we can get a little read on what commodities have done over the last year. And even though they've picked up here in the last maybe 2 weeks or so, we've seen commodities rise really nicely on the Bloomberg Commodities Index. We know this is a volatile chart, and clearly we're way lower now than where we were a year ago. If we go year to date, we're roughly where we started the year, so we're kind of flat year to date. And we've looked in the last 5 years, we could see post-COVID when we were really raising rates. This would be a lot more similar to what you saw in 94, this rising of commodities prices, giving the Fed cause for concerns. Not so much this that we're seeing over here, which is a very clear downward trajectory. So again, something essentially the opposite today than what we saw in the mid-90s. And so then the Federal Reserve was questioning, okay, hey, well, look, we've got real GDP at 3 to 4%. We fell to a low of about 3.5 to 2.5, 2.2 at the absolute lowest point in 1995. And then we went right back up again in 96. A lot of folks think that we might see 24 or 25 be that sort of hole in GDP, or maybe even 22, and then we sort of rise out and our GDP actually really starts taking off again. Of course, back then, the Federal Reserve was worried about overstimulating and concerns about still a tight labor market. And they didn't really have many geopolitical concerns. See, like today, we are not really concerned about overstimulating the economy. We'd like to see kind of growth stay up because we're actually not so much worried about a tight labor market anymore. We're worried about the job openings rate plummeting. And even though layoffs haven't really started yet, a lot of folks are concerned that we could just be one market correction away from a surge of layoffs, that companies are ready to lay off when everybody else lays off. Because if you're the only one laying off, your stock could get hit as a sign that, oh, you must be the weak one, not able to earn money in this market. So they sell your stock. Companies don't like that. Look at IBM, for example. IBM is doing something right now called quiet layoffs, and IBM confirmed this, but there are reports right now that IBM is, quote, reportedly cutting thousands of jobs this week. The layoffs are being conducted with non-disclosure agreements. You can see it here. This is Times of India, but they're reporting from, this is everywhere. The Register first broke this news, and so a lot of people have been talking about this. Again, it's confirmed in the company earnings. They've been talking about workforce restructuring, but they're really not wanting this to be big news because it hurts your stock. And once everybody confirms job cuts are happening, that's when you really start this sort of cycle of layoffs. And that's what the Federal Reserve today is trying to avoid, more of that. And keep in mind, we also have a lot more uncertainties today than we did in 94 when it comes to geopolitics. I mean, look at Iran, Israel, Gaza, the axis over there. Then you've got China and recession in China. You've got Ukraine, Russia. There are a lot more issues than we had in 94, maybe even a little bit more political volatility. But then when we get to the minutes of January 95, once again, no mention of the labor market weakening. Instead, we focus on a Mexican financial crisis, which they stopped talking about by July of 95. And this is where they talk about inflationary pressures having moderated and starting to potentially assume and declare victory on inflation, that inflation was under control. This is, by the way, similar to today. But while they're talking about winning on inflation, they still had concerns over an overheating economy, which is different from today. It's actually, again, the opposite. The labor market was also still deemed tight. When you got to September of 1995, labor shortages were still being talked about. Companies were apparently, these were anecdotes coming from the actual transcript. They talked about in-house labor being used, like cross-training their employees because they can't find workers to take new jobs. They even started talking about certain companies feeling, quote, discouraged because basically they can't find workers, so they stopped expanding their businesses because they couldn't find workers to fill the work. In other words, the economy was actually good and growing rapidly. They didn't have concerns over weakening. They just had concerns that there weren't enough people to work, and you had these labor shortages that could lead to inflation, but we never got the inflation from those rising wage pressures. Now, there were also virtually no mentions of layoffs, which is a bit of the opposite today, where the Federal Reserve says, we're not seeing layoffs, but we're attentive. So there's a reason for this. The reason, and I haven't pulled this chart up yet, but I had it handy. Actually, I pulled it up, I just didn't show it to you yet. The reason, and I think this is the perfect place to bring it up, is take a look at this particular chart here. This chart shows you the unemployment rate and the federal funds rate, the effective Fed funds rate. So what I want you to notice is right here, going into COVID, there was no increasing of the unemployment rate. We just had a sudden shock, a pandemic, right? That's fine. Okay, going into the 2007 recession, what do we have over here? Unemployment that started rising. In fact, the unemployment rate bottomed in 2007. Now, this is important. You want to kind of pay attention to some of these numbers because they're going to give you a little bit of, how should I say, help in understanding, where we sit today. The unemployment rate bottomed in 2006 in October and May of 2007, about 7 to 13 months before the 2007 recession. So in other words, you had about almost a full year here of rising unemployment before the recession. Go to 2001. In 2001, the unemployment rate bottomed in actually April of 2000, 11 months before the March of 2001 recession. So again, you had about a year of rising unemployment. And notice it rises very, very slowly going into the start of a recession. But the point is, it rises. Just like you had this increase in the 90s. And if you go back in time as well, you'll see that in the 80s, a slow rise going into it. And you either come from this floor or as the unemployment rate starts going up, the recession begins. This is pretty consistent. What's interesting about the 90s is look at the 90s right here. As the Federal Reserve was lowering the FOMC Fed funds rate, which is the red line, the blue line consistently fell. The blue line actually fell from 1992 all the way to about 2000. You had 8 years of declining unemployment. That is exactly the opposite of what you had in 2001, and it's the opposite of what you had in 2007. And I hate to say it, but folks, it is the exact opposite of what we have today. We have rising unemployment today. We don't have a 9-year trajectory of declining employment where as we're reducing rates, the unemployment rate is going down. We're actually reducing rates now 50 basis points as the unemployment rate is rising. And we're trying to stop. It's like we're trying to plug the leak, if you will, in the sinking ship. I hate to say it. I hate to use sort of the Titanic reference, but it's kind of like there's a hole and you're trying to plug it. Whereas in the mid 90s, there was no hole. And notice how in these FOMC transcripts, what they are describing is an economy that is extremely the opposite of what we face today. Do we have a labor market so tight that some firms are considered discouraged? It's crazy. Or here's another one. They literally saw a risk of the potential of a positive demand shock suddenly sending prices up. We're worried about demand falling off a cliff. Not worried about a demand shock running this market back towards inflation. Now, I know some people argue there could be a second wave of inflation, and that's after the Federal Reserve starts cutting aggressively because of the employment problem. Then we get a second wave of inflation. I don't think that's likely. I actually think the Federal Reserve is and this is my opinion, right? Everything I've described so far, this has just been fact. This has been, and then I want to get into this Challenger report here, which is freaking crazy. But, the market that you've described or just heard about in the 90s, is the opposite. It is not even slightly different. It is literally an opposite market of what we see today. And let me evidence that to you by showing you the Challenger report that just came out. This was scary. Job cuts announced by US-based companies surge in August 2024. Hiring falls lowest year to date since Challenger report began tracking in 2005. This was out September 5th before the Fed meeting. US-based employers announced 75,000 cuts in August, a 193% increase from the 25,000 cuts announced 1 month prior. So something started happening in July and August. I understand they didn't have the layoffs yet in July, but when we look at earnings, we could see some slowdown started in July. And then that led to layoffs in August. Now the question is it going to lead to more layoffs in September or not? If the layoffs pick up again in September or October, or worse, like at the end of the year and the beginning of the year, after the holiday season, maybe businesses will try to hoard labor until then, and then the real poopsie-doopsie hits. We're going to have some real issues because now you're going to have a Federal Reserve that is dealing with the same situation that you had in 2007, the same situation that you had in 2001, and not the same situation that you had in the 95 soft landing. Again, everybody keeps talking about the 1995 soft landing, and that's why I thought to myself, well, okay, I'm going to be different. I'm going to actually go read the Fed transcripts and try to understand what it was they were seeing then so I can understand. Think about some of these other numbers here. PwC, I mean, you got some small layoffs. We talked about the IBM cuts. PwC is laying off 1,800 workers. What was interesting about that was not the number of workers, but it was that they had their first layoffs since 2009. Yeah, crazy. IBM's talking about replacing workers with AI. GM, Cisco just announced additional layoffs, although warn notices aren't really that high yet. I think people might try to hoard through the next few months here. There could be some real uncertainty come post-holidays, but we'll see. Some other things that are worth looking at in that Challenger jobs report is that this is the second highest level of cuts announced since 2009, excluding COVID, which definitely indicates some form of economic uncertainty. Now, in fairness, a lot of the layoffs, more of the layoffs out of all of them, 16,439, reported that the layoffs were because of market and economic conditions, but twice that were because of cost cutting. So at this point, twice as many companies are still saying, oh, well, we're just cutting costs. Whereas, half as many of the cost cutting are saying, oh, well, we're laying people off because the market sucks. In a real recession, like when you're in it, that flips. People are like, yo, we're in a recession, man. We're sorry, we're just laying off everyone. So, in my opinion, from what I'm gathering, we're not quite there yet. But we seem to be knocking on the recessionary door. And the issue with this is trying to time when the recession is going to strike is literally impossible. Because quite frankly, you could have a Japan-style carry trade shock tomorrow and it lasts longer, boom, you're in recession. Or you could have the market just keeps going up and keeps melting up, and then all of a sudden, post-holidays, oh no, Black Friday sales weren't that good. All of a sudden, people start cutting way more than expected in January, and then that's where your recession actually begins, in Q1 of 2025. Who knows? These are all things TBD, but I will tell you, the one thing that I think will do well over the next year with more certainty, and this is not a guarantee, obviously, but I personally think bond yields are going to have to come down dramatically because A, the Fed cut 50 to try to support the markets and yields went up. So the Fed has to talk these yields down. If they can't talk the yields down, they're going to have to cut more because if they don't cut rates more rapidly than the market is expecting, they will probably miss the opportunity to create a 1995, which honestly, the data we've looked at so far already suggests we're just not going to be in 1995. But even if we are in 1995, we have to spur hiring in an economy that avoids a recession. You can do that by cutting rates more than expected. And if you have a recession, you cut rates more than expected. So either way, soft landing with slower growth, you need to cut rates more to encourage businesses to hire. And in the face of AI, it's harder to encourage businesses to hire because they're just like, I'll just have my existing workers use AI more. I know that doesn't work in every single field. Obviously, there are AI resilient, businesses like try to get, AI to build a house for you. There are some things you're going to have problems with replacing AI with, but sales, some forms of, frankly, white-collar businesses are going to face a lot of AI stress. And so in my opinion, that's going to lead to a Fed that just has to drive rates down further. And I also think there's so much slack in the economy, both in the jobs market and manufacturing, that I just don't see a second wave of inflation because even a pickup of demand would just fill the slack that we already have in businesses. Businesses are ready for more work. That's what COVID did for them. It helped them get ready for more work, and now there's not more work. And so it's either we prevent more layoffs or we grow. But both of those are going to require lower rates, which, again, in my opinion, bodes really well for the bond market. And as far as stocks, it's going to be an either or. You either get recession, stocks tank 50%, or you get no recession and stocks can keep running. So Let me know what you think in the comments down below. Thank you so much for watching. If any of this makes you nervous and you want to get life insurance in as little as 5 minutes, make sure to go to metkevin.com/life. And if you'd like to get some free stocks with Webull, make sure to go to metkevin.com/Webull. Metkevin.com/Webull. That is, both of these actually are paid promotions with the channel. Take a look at this. You go to Webull, the trading platform I love to use over here. What do we got? Earn up to 75 free fractional shares and 7% APY, that extra 2% APY on 5% for the first 30 days. Click here to start. So go check this out. Check out that bonus, metkevin.com/Webull. I've got it linked in the description as well. Both paid promotions. Thanks so much for being here, and we'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.